Equity markets continue to show the resilience despite various headline risks, including geopolitical tensions, ongoing military conflicts, and various contentious elections around the world. Joining us more for what he is focused on and is interesting is Brad Simpson, Chief Wealth Strategist at TD Wealth. I always say I feel like I've never been in markets where there's more going on, but I feel like every year I do this, there's more and more going on. So
yeah, I get that.
Yeah, and it's geopolitics. I mean, that really is what the focus seems to be right now.
Yeah, well, I do think there is a recency bias whenever we're thinking about where we are in a market. But we published an article a couple of years ago, really, the treatise to our clients saying that in a world that we're moving towards, we can't as quickly and easily fall back on patterns of saying that there's a globalization and that we're now in a world where you're going to have a lot more deglobalization. And then part of that process is going to be that you're going to have a lot more geopolitical strife. And then part of that is you're going to have a lot of more political strife. And indeed, I mean, that's what a lot of what this world looks like. Mm-hmm. And so I think, we published our monthly WAC perspective. So we have our asset allocation committee meets, and then we basically publish our notes from it and then our suggested allocations. And when I looked at the front page, what we wrote down had nothing really to do with financial markets. It was like, here's all the significant things that have happened since last time we wrote, and they were all, war, election, right? And so I think when you add that up and you go through that, I think one would think was, boy, it must be turmoil in investment markets right now. I mean, look at this list of things. And yet, because I think you could make a very convincing argument that this is as a geopolitical stressed environment that we've seen since, let's call it, Cuban Missile Crisis to the end of the Vietnam War, right? And that was indeed a very contentious era there, and so. If that's what you're saying, you would think you would have that turmoil, but that's not what we're seeing in financial markets.
Well, let's pull up the chart, because you brought one, I think, that kind of illustrates that point quite nicely. So this is a look at large cap growth and what we've seen. So tell me what we're looking at here and why that is relevant to what you're saying right now.
Well, I think what's relevant to saying is I think we all know about AI, and I think we all know about either the promise of what AI is going to be or also what the threat of AI is going to be. But one of the things is, and I think we've heard a lot of talk about this, but we're trying to look at it in a somewhat different way. What we're seeing here is we're seeing the percentage of the S&P 500 that is now made up of the top 10 stocks. And most of those are tech companies that are driving kind of the AI boom. I don't think that's new news. I think the way of looking at it, though, is saying, look at the black line the return is relative to the equal weight of the S&P 500. So you take those 500 companies and don't measure them according to how much they make up of the index, but make each one of them worth about 2%. And so the outperformance of these 10 names is incredible. I think part of that is you look at it, is with all these risks going on, but that people are wanting to allocate into equity markets, the sure bet, the thing that you can look at is to say, well, I've got this AI thing. It's going to be really big. I don't know what that's going to look like, but I know that it's going to be big. And so I'll allocate to those names there. And I think that part of actually the actually risk aversion that's going on in the geopolitical environment is getting expressed through that allocation. Now, what I was showing up against it on the other side of that is that it's sort of the warning to investors to think about a little bit is that much of the things that we think of the benefits of AI are going to have to companies will come true. What I was showing on the other one was saying Cisco's returns up until 2001, and Cisco is really the picks and shovels of the internet boom. Yeah. But once that hysteria around it collapsed, Cisco was back down to its low for about 20 years. Yeah. And all the promise that the internet happened, but it took a lot of years for it to happen. So even if this AI takes less time, and with its ability to double every 6 months right now, you can pretty quickly do the math and go, it will. That I think the most fascinating part of the story may be that this is one of the elements of folks who are, and folks, institutional investor, wealth investors, and pros in general, their risk aversion, they're actually displaying it through their allocation into those names. And I think that's pretty extraordinary.
It is. It's fascinating, and it's a nice parable when you put it up against Cisco just to understand it. I guess I would say then this is still very much an active manager's market. I know you feel that way too.
Yeah, I think if you look at it, there's a thing that we often call an alligator chart, and that is if you have 10 names go like this and the rest are here, at some point the mouth closes, and in choosing as that. The ones that haven't been moving start to move back up again, and as this comes down, the reality is that active managers, what they do really well is to say when this transition occurs, is that where do I want to allocate to in a market like that, and I think this, if you're looking for sweet spots of where active management makes a lot of sense, and I don't just mean in equity markets. I think that's true in public fixed income markets. I also think that's true in private markets. Mm-hmm. This is very much going to turn itself into one where active management is going to make an awful lot of sense. We
didn't talk about interest rates, though, which is usually what we tend to lead with
right.
For the past 10 years, but maybe let's bring it back to rates.
Right.
You've got a couple of charts here you want to share with us with an outlook for what you're looking for in terms of what you're expecting with rates. So this first one compares U.S. policymakers with central bankers outside the United States.
Yeah, and I think kind of the gist of what is that while the ecosphere is fascinated by geopolitics and politics, markets are still really interested in one thing right now, and it's interest rates, right? I mean, that is then, and so what we're talking about here is that this desynchronization that we've gone through is that when you're asking the question about rates, you kind of have to go nation by nation, but you can do that pretty quickly now. The Eurozone, and when you look at this and you're looking through job gains, because the last thing if you want to get to that 2 to 3% for inflation, is now the last thing has to give is labor markets.
Yeah.
And we're starting to see that. And so we're looking at here is going that job gains are slowing in the Eurozone, and indeed that's where you're looking at. The United Kingdom, if you look at the sweeping to power of the Labour government there, a lot of that would be all you have to see that orange line dropping to the bottom. They've got the worst job gains, right? So when you have that sort of if you're an incumbent, you're in big trouble in any election. And then then you look at Canada, job gains slowing. Important one is U.S. job gains slowing. Why is that important? The biggest question in the market right now is when are interest rates going to drop in the United States? And this is a really good sign of saying if you start getting job gains start to slow, amongst other things that are started going on, is that it isn't far off. The market rate now it's an 82% first cut in September. Mm-hmm. It's 100% 2 cuts by December. That's the market's outcome, right? Yeah. Call it somewhere between 1 to 2 to the end of the year. But it doesn't matter what month it's going to be. What it is that it's another amongst many others showing that the U.S. is slowing. And so I'm being clear on that, because sometimes people go, well, gee, you guys talk about negative things and sound so bad. Like, this is what we wanted to see. Mm-hmm. It's just you don't want it to slow too much.
Yeah.
But in that, the story now is all in. And the one we don't have in the majors that we look at is China.
Yeah.
And China, 2 things. One, their unemployment rate's 5% forever. So we know that's not an accurate number, right? And the second one, though, is interesting. If we can go in and we can look at the change of the tax receipts of people who live there, those tax receipts their income is down about 6% year over year. Mm. That shows you declining employment, and that's actually quite a rather, let's call it quite an ugly number, if you will. Mm. So, and you throw in, let's call it 14 to 16% unemployment and youth unemployment there. That it equally matches this as being the slowest in this when we look at them. So, and indeed it is at different levels we can see the economies around the world slowing.
Yeah, and interesting too in China, different dynamics, but with a leader who's, so much depends on economic stability and prosperity too, right? That's so important too.
Right.
You've got another chart we're looking at here, and this is the potential timeline. You mentioned the first cut by the Fed and what's been priced in right now and what we're seeing.
Right. So all we're looking at here is that two-year bonds, when you look at 2-year Treasury bond, that a government Treasury bill that were from the U.S. government that will mature out 2 years. And when the Federal Reserve Board is dropping interest rates, that's a positive for the bond market and these two-year bonds. What happens is the price of the bond goes down, the interest rate tends to go up, and you have the potential to be able to get a capital gain there. And so we know that if you look at 90, 95, 2001, 7, 19, when you cut rates, typically the bond market really starts to move. We have seen in the last 4 weeks here a rally in fixed income markets already. And I think our point here is a couple. We are overweight fixed income. In particular, we think there's a really good place to be allocating into the kind of the 1 to 3 zone. Orav Guy, who is a portfolio manager for the fixed income side of my team, has a updated publication that he did called Bonds versus GICs. And really what we're showing there is, like, as interest rates go down, your GIC matures. It matures at that level now at that lower interest rate.
Right.
And you're kind of stuck. In a bond portfolio, what you can be doing is you can be managing that. Interest rates can be going down, but you're actually making money from a capital gain when that happens. So we think that for folks who were reluctant to be in the fixed income market, this is a really good time to at least evaluate it and assess that with an environment like the one we have here. At the end of the day, fixed income markets are different than equity markets. It's math. I mean, at the end, right, it's just straight math.
Yep.
There's less and less emotion on it. There's just the math of it, and the math is pretty good.
Yeah, and just finally, we've only got about a minute here, but I was going to say in terms of the private markets too, like there's been, obviously over the last decade, I mean, it's become more attractive, more people are interested in, so I'm sure you're seeing that. But the problem with that too is also just liquidity in terms of what you can get in and out. Yeah,
look, we're in the middle of doing a deep dive on that for our Portfolio Strategy Quarterly at the end of the month. And that in an environment like this one, again, is that I think a lot of the opportunities that we're not seeing, that we're seeing at the kind of the beginning here of how much is flowing into private market or into the Mag 7, there's a lot of risk taking and opportunities that are happening in the private space, both on the debt side and on the equity side. And so for people who have a longer time horizon, and I mean by because one of the things is liquidity, meaning you can lock up your capital for 1 year or 5 years or 10 years, right?
But it's locked up.
But it's locked up, so you don't have the ability. But if you have if you have the ability to be able to do that, and we as do a lot of allocating into that space, it's quite an attractive area right now, and we think makes a lot of sense for folks who have the ability to be able to allocate that way.